Welcome to iGlobal Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you very much for joining me. Well, it's been a very challenging few days, especially with the direction of the markets. It's been very confusing in terms of the commodities. Starting with the Australian dollar, the fact is that the market slipped further on Friday against its US dollar rival as growing fears between the US and China trade wars could turn for the worst for commodities and commodity-based currencies, including the Australian dollar. Last week, the market dropped like a stone and surprisingly dismissed the better-than-expected Australian employment figures released. The pair plummeted from a high of 75.81 to a low of 74.80. And then on Friday, prints a fresh 4-week low of 74.38. And now this morning, posts a low of 23, which is where the intraday support is seen at 74.20. My expectations to the downside is still negative, and I viewing a target of 73, 75.85 before the market is likely to show any potential demand. So do be on your guard that the market still can fall a little bit further, with 74.65 seen as a short-term resistance. Well, starting with the dollar index, on Thursday the market rallied to a fresh high of July 2017 of 95.12 before reversing and plummeting to a low of 93.91 to the index on Friday. For the week, though, the dollar index was up 1.33%, its best weekly performance in 7 weeks. However, from plummeting does give some question of where the market direction is at present. Now, a few things to keep the market in tune in terms of the bearish case is that the Fed last week is now notched up 4 potential rate hikes for this year. Viewing the dot plot and solid local data, including retail sales and inflation, and along with Friday's surprisingly strong preliminary Michigan Consumer Sentiment Index for June, which came in at 99.3 versus the forecast of 98.5, is the dollar index should continue its path and hold to a bullish case. This in terms would see the euro sell off further and look towards the region of 112.80 as a broad target. Along with this is that ECB last week, President Mario Draghi did say that they are looking to taper its program of monthly bond purchases later this year. Previously, quantitative easing QE was scheduled to last until September, carrying the monthly purchases of 30 billion or 35 billion US of government bonds and private debt. This will be reduced to 15 billion euro during the last few months of this year, and then looking for a tightening mid next year or close to summer of 2019. As I mentioned, the support was crushed at 116.60 last week. This in terms has opened and exposed the region of 112.80. Resistance seen at 116.55 to sell into, as I believe that will be an intraday cap. The dollar yen should still keep to its bullish tone, and I expect to see the 111.15 target challenged. So far this morning we've seen a high of 65, but it has retreated slightly. I believe the market from 35 or towards 109.60.80 is a buy zone, and we should see further recovery eventually to take on the challenge of 111.15. The bears are still lingering for the pound since the rejection of 134.5 for the second time. That was on late last week, and now posting further threat to a target of 132.10, which was near enough the low on Friday. We do have this week the Bank of England to hold its rate decision, and it is widely viewed that the benchmark will hold its rate at 0.50%. But this could all change quite easily, and a surprise hike would surprise the market and maybe see a squeeze, but wait until we get closer to Thursday at 9 PM Sydney time for the Bank of England's release. The gold plummeted on Friday and surprisingly didn't hold at any level from 88 nor down to 78. And now from the break of 78 does expose the region of 55.60, but I'm very cautious of this call. So I would really like to sit out at the moment and just see how the market recoups on some of its losses, or will it? So 24 hours to 48 hours to assess the intraday action to see where the market is poised to. But at the moment, it is vulnerable to the downside as 55.60 may be holding as a near-term target. Gold did also plummet after rejecting for the second time from that broad trend. As you can see here, was very, very strong from the rejection, crushes through 85 support, and now puts on the target now to the downside of $16.35. It is assessed from there that the bulls should still be harboring from $16.15. And rounding off with oil, as you can see, my view came through from the bearish pole of the flag. The measure moved down to 62.40.80, still intact. After the rejection on Friday of $66.88 to $67 was clearly rejected, and the market fell 3%. And from the fall, keeps the target to $62.40.80 a barrel. Resistance is now seen at $65 figure 30. Well, that wraps up for today. Thank you very much for joining me. And as always, look out for the intraday report, and I hope you enjoy the great start to the new week.